Good afternoon, everyone. This is Edward Talisse for Chelsea Global Advisors and the CQF Institute. Welcome to our next installment of our weekly video series. So, since we've been last talking, what has been going on in the market? Well, I think everyone knows that equity markets have seen a strong recovery from the price action that has occurred for most of the beginning of October all the way through about the 15th or 16th of October, where headline indices decreased anywhere between 5 to 8%. Since then, most equity markets, particularly the S&P 500, have seen strong recoveries in price action and are now only down for the month of October anywhere between 3 to 4%. So we'll keep sticking with our position that we do think that risky assets between now and the end of the year continue to offer investors the best risk-adjusted returns. Most important thing that's happened since last week is that we're in the midst of the third quarter earnings cycle for U.S. corporate earnings. So far, about 65% of companies that have reported earnings that are above analyst forecasts. So far, we don't really have any story about a growth or earnings recession or even a dividend recession. So far, EPS for U.S. S&P companies are growing at an annual clip of between 2 and 3%. It's actually much higher, closer to 9% if you exclude financials, whose earnings have been greatly harmed by the amount of legal payments that continue to plague that industry. And top-line revenue is also growing between about 4 and 5%. So again, so far, third quarter earnings as expected, and we don't really see an earnings or dividend recession. More importantly, so what are we focusing on now, looking ahead for the next week or the next couple of weeks? Well, firstly, in our metrics to matter, we always look at inflation expectations in the U.S. We use the Fed's preferred measure, five-year forward inflation expectation measure, which you could find on many websites, and it's on the St. Louis Fed's website as well. That indicator has been falling and falling quite aggressively since the beginning of the year. In the beginning of 2014, the five-year inflation rate was about 260, and right now it's close to about 240%. Inflation expectations are also falling in Europe, obviously, and in Japan to a lesser extent. However, the key point here is that as long as inflation expectations are falling, it's highly unlikely that the Fed or any other central bank would embark on anything other than a very, very mild hiking campaign, if they elect to hike even at all. Secondly, soft commodity prices, particularly lower oil prices, have really pressured headline inflation indices even further. And over time, if oil prices stay where they are here, it's very, very hard to see inflation expectations rising at all. Additionally, lower oil prices prove to be a huge boom to consumers in this country and indeed across the globe. So as oil prices and hence gasoline or petrol prices are falling, U.S. consumers could expect a huge windfall that should boost consumer spending and other investments as we head into the end of the year. So I think most retail outlets are very happy to see the prospects for the holiday shopping season improving greatly. We'll have to stick by and see what happens. Lastly, I think the upcoming outlook is very important to watch for the results of the ECB stress tests. This is where the ECB is going through similar stress tests to the U.S. Federal Reserve, and they're probing the capital and dividend plans of most European banks. Those tests are scheduled to be released, I believe, on the October 29th, so in a couple of days from now. I think the ECB is in a very difficult position here because if the results of the tests seem to project a rosy or optimistic outlook for European banks, then I think those tests may prove to be deemed uncredible or lacking any real teeth or bite. On the other side, if those tests come out and say that the European banks, which we all probably think anyway, are in pretty dire shape and need to go on further capital expansion plans, then the markets could see another round of setbacks, particularly in Europe. So what I thought I'd do now is just recap my core view on the markets, which again remains very constructive for risky assets, particularly in comparison to bonds and into government bonds in particular. I do recommend for my own account and for accounts of my customers that they move a portion out of risk-free government bonds and into high-yield bonds. High yield has been hit hard in the recent sell-off, and now there are bonds out there that have attractive yields close to 7%. What I thought I'd do now is talk a little bit about something that I call the equity duration index, and it really is designed to determine just how sensitive U.S. stocks are to changing interest rates. The concept was developed by researchers at S&P a few years back, I believe in 2009, and it really is trying to measure the degree of sensitivity of stocks to changing interest rates. The key concept here is the correlation between the equity risk premium, and on this chart it's represented by the red line, which is Baa yields, and the dividend yield, which on this chart is represented by the blue lines. The idea is that as the equity risk premium declines, as it has been, the duration of an equity index will extend, meaning that it's more sensitive to interest rate changes. So if you think about the three key factors that drive equity prices being earnings, growth, and interest rates, we have very good information on earnings growth. We're in the midst of the earnings season. We have very good information about global economic growth here in the United States and Japan and Europe. However, we don't really have a good metric to measure the sensitivity to equity prices for interest rates, and I think equity duration really plays a very handy role in that. So if we take S&P's research method, we come to the conclusion that equity duration today is around 20, meaning that the headline equity index is around 2 to 3 times more sensitive to a change in interest rates than a 10-year government bond. For investors, that means that if you believe interest rates are going to stay low or perhaps even going further, equity should respond better or more strongly to lower interest rates than government bonds, at least from here, simply because they have a higher duration. However, if you think the trend is going to change and interest rates are set to move higher, then equities are perhaps a more dangerous trade than holding government bonds, even at these very low interest rates. That's it for this week. Thank you very much, and I look forward to our next weekly video session in about 7 days' time.